Welcome back. You're watching HFO-TV.
Welcome back to HFO-TV. I'm Greg Frick, partner at HFO Investment Real Estate. Back today with us on HFO-TV is Michael Wilkerson, project director and partner at ECONorthwest. Thanks again.
Yeah, my pleasure.
We're going to talk today about a report that you guys were commissioned to do regarding housing production in the United States and really kind of focusing on Oregon and Washington.
One thing I think when we talk about affordability in Portland, and this is a slide I've been sharing now for several years, people often wonder, well, was Portland ever affordable? When did this change?
When did we kind of cross the, yes.
And so this chart basically answers that question. It's in 2010. And again, no coincidence that in 2010, when we saw almost no units delivered,
Coming out of the recession, lenders were slow to get back involved in
it. So incomes were down.
Yep.
People were losing their jobs, but at that time, rents actually were going up. So that, is a different narrative than we generally see. But rents traditionally were
now,
around.
Was that because you think of immigration?
Correct. Strong immigration.
Coming into this.
Yeah. Also, you had a kind of unique circumstance where people were losing their homes. So people were moving out of homeownership into rental units. So you had a lot of factors were say, abnormal that you wouldn't expect to see. But I think the major story here is, prior to 2000 and all the way through 2010, if you're earning 60% of the median income, that's affordable. And why that matters is federal tax credits are targeted at households earning 60% and less. Right. So if you already have a large number of units at 60% or below, you don't really necessarily have a strong need to deliver affordable housing units. But once you move away from 60, and in Portland we've moved to 100% of median family income now, you have this huge gap of people that aren't eligible for federal tax credits at 60%, up to 100%, where they're cost burdening themselves. So they're spending more than 30% of their income because rents have gone up so much relative to incomes. And that's kind of one of the main stories that we've seen in Portland, and the data kind of bears that out. So again, the main driver is supply. And I think when you look at what was delivered in the previous cycle, we saw a peak of about 3,000 units in 2006 into the market. The pipeline shut off completely to where we had fewer than 1,000 units for 2 years in a row, and then we saw this huge ramp up in 14, 15, 16, and 17 now, where last year we had 6,500 units.
But that's still, even at those numbers, that's still not keeping up with household formations. That's the part. Correct. I think a lot of people don't understand is, when I'm talking to people out there is, geez, I see all these cranes, I'm like, you understand, but A, we had a lot of making up to do. Yep. But we're still not keeping up with immigration. So it's again, trying to educate people as to, there's reasons why we are where we are, and like you said, you can boil it down to pretty, supply and demand, and that's, it's good for people to see this. So.
Yeah, and I think one of the reasons why we see kind of units being delivered at lower rates is there's this kind of natural maximum that the market can deliver. Right. And that's generally constrained by lenders. And we started seeing even 2 years ago lenders pulling out of Portland saying, we're delivering too many units in the same area at the same price point, because yes, lots of people are moving to the region, but not all of them can afford the rent at the new unit. So it's a much smaller subset of those people. So you can only build so fast to serve those households who are willing to do that. Now that benefits everyone through filtering, and many other people, Joe Courtwright, the state economist, lots of people are on record talking about that process. And Sightline Institute's done some great work looking at that in terms of, well, how does that help somebody else if someone's building a unit that costs $2,500 a month? Well, that person would be buying another unit, and then it.
But the Class A built today becomes a Class B in
Correct.
5 years.
Exactly.
But again, it's like you said, if you're building a lot of Class A, if those units aren't there, that person that can afford a Class A is now looking at a Class B, and it's just each group kind of moves down a segment or moves up depending on what's being supplied. So.
Yeah. So we've seen the market kind of say we can only really deliver and absorb this much, and that's when the lenders say we're not funding projects anymore. So it's not that there's a lack of land, which we hear about a lot. It's not that construction costs are so high. It's not that, whatever the case may be. It's that literally they look at the risk profile of the market of Portland, and yes, we've grown a lot, but we are still a relatively small market. And you see that there are, I think, the 4th most cranes in the sky right now in Portland of any city.
Seattle's 1, I think we're 4. Yeah.
And we're not the 4th largest city in America. So you can see the lenders, see that and see, risk. So they pull back, and that's the first sign of when you see it's absorption related more than financially related. So you've seen that already priced into that in 2018, where we're going to deliver 6,000 units, which historically is probably the second highest year on record. So it's a huge amount, but the demand is probably stronger now than it's been, but we're delivering fewer units.
And again, we're also trying to catch up from these years where we weren't doing any deliveries. So it's
Yep.
Yeah.
And 2019 is, already one thing it's nice about being an economist is people ask me to forecast things. I say, I don't have a crystal ball, I can't do that. The one thing I can forecast is I can tell you in the next 2 years how many apartments are going to get built, because it takes several years, 3, maybe 4 years from land use permitting through building permitting through construction financing through your build out of 18 to 24 month cycles. So you know pretty much with certainty what's going to happen for the next 2 years, and there's nothing you can do to change that. If you today said all of a sudden 1 million people moved to Portland and they all had $10 million bank accounts, you couldn't build any faster, even if you wanted to supply them. So that it is what it is. And so I think now we're looking at 2020 and saying what's going to happen in 2020. And we've seen a huge drop off in the amount of permits. And permits don't always equate to units, but it's the best indicator we have of kind of what's in that pipeline. And we're looking like in the city of Portland, maybe 2,000, probably less.
Which again is going to put us back in the same situation of too much demand, not enough supply.
Yep.
And so okay.
So that's multifamily in general. I think one thing that isn't getting talked about a lot, but certainly has impacts, where we see ownership product is becoming very unaffordable in Portland. Right. Single family homes, condos have been bid up a lot, and the reason for that again is there are no vacant single family home lots in Portland. There are demolitions, and there are maybe some that are going duplex and triplex, and now with residential,
enough to move.
Not a number is enough. So it's condos are where you're going to add to the supply of ownership. When we look at the last cycle through 2009, close to half of the units delivered in multifamily were condo.
Right.
When I go around to other places, certainly in Canada and Vancouver being one of them, and I say that less than 5% of the units built in this cycle are condo, they are dumbfounded. They don't understand how is that the case? Why is that the case? Because in most markets it's 50-50 or in some markets even higher. And so the question becomes, A, why? And then B, what's happening from that? If we're building 200 condo units last year, we look forward next year, again, we know with certainty there's 2 buildings coming out of the ground right now. Vista and the Pearl, that's 150 units, and another 160 units in Sullivan's Gulch in the 2020 property. So we're going to be lower than 200 for the next 2 years.
And there's no conversions. I mean, there was conversion. We were involved in a lot of conversions back in the early 2000s. That market's been done. So it's, again, we get compared sometimes. I'll hear people talk about housing advocates about, comparing us to Vancouver. And I always say, you look at construction in Vancouver, they're building different product. They're building condos there. We're not building any condos, which again is putting more pressure on the price of single family homes.
Yeah. So this we look at as an opportunity, and so what are the policies that can maybe be there? But a lot of it is in City of Portland is inclusionary housing. I think when you look at apartments and you try to say, well, inclusionary zoning was just timed at a very bad time, and we knew that as industry before they even put that policy in. We were saying the industry has already changed. We don't see it yet. Rents look like they're still going up, but that's not going to be the case in 2 years, and now we have the data to back that up. But on the condo side of things, to calibrate an inclusionary policy for condos is very, very difficult. For apartments, I think you look at the math and you can say, maybe inclusionary has some very small impact on feasibility, but feasibility for apartments has changed completely, and it has little to do with
on the
inclusionary.
Condo side, completely.
Condo can be, we're talking hundreds of thousands of dollars per unit difference, and that's just makes it completely financially infeasible to build. So, I think looking at that policy and figuring out are there alternative ways that we can structure that to incentivize more condos, probably the easiest thing from a policy standpoint to do. Okay. The largest constraint, though, is simply lenders' risk appetite. They want a huge amount of pre-sales. So a developer has to bring their own capital to bear. They have to find an entitled piece of land. They have to go through design review. They have to go through architectural costs. They're putting forth generally millions of dollars hiring a sales staff for the purposes of pre-selling units before they can even get 1 cent from a lender and qualify for a loan. So the number of people who have that appetite for risk is low. when you have a thriving apartment market. So I think what will be interesting is as the apartment market starts to change,
Do we see a switch back to
what we've seen in previous cycles, or is risk different after the global financial crisis? Is inclusionary housing, contributing to that? Are things like construction defects or other things potentially fixes that we can do? So what that leads to is this broader discussion of, well, rents aren't going up anymore in Portland. We peaked in October of 2017 from positive to negative. Rent growth was at its highest in January 2016. So when we implemented an inclusionary zoning policy in February of 2017, rents were already on the decline for close to a year, and 5 months later went negative. And that has nothing to do with that policy. It was just timed already in
deliveries and
what was already happening in the market. So I think the question is, well, why? So one of the reasons that we saw rent growth so high was record numbers of units being delivered at a higher rent than the existing rent. What we see now, I think when you see zero, is one way to think about that is, well, every unit's not changing, and that's absolutely not what's happening. There are certainly units that are going up and units that are flat and the units that are going down. So when we look at a spread of units, this is from January 2017 to January 2018, average of all those units is slightly negative. But you see many units where rents are going up 5, 10%, and many units where rent's going down 10%. And oftentimes rent isn't actually going down, it's a concession. So you're offering a 2-month concession. That's a big percentage drop. What we see when we look at the data is City of Portland is different than the rest of the metro. The rest of the metro rents are going up.
We're showing, still continuing to see rent growth on the rest of the metro.
But in the city of Portland, you weren't. And really, it was the newer the unit, the more likely it was to be flat or decreasing. So stuff delivered in 60s, 70s, 80s, 90s, still going up in value. It's really stuff delivered in this last cycle since 2010, where they've had lots of new deliveries and absorption's been a challenge. And that's why we've seen that flattening off. But I think we've already seen concessions starting to come out of the market. So the next thing is going to be rents are going to be going up. So we can kind of predict that this next run up is going to be happening. The challenge, I think, is something that's completely out of a policymaker's control is cap rates. And the reason that development has been able to thrive despite construction costs going up at 10, 15% a year is when the value multiple you get for the same unit is higher. Even if on a per unit basis you're delivering less net operating income, you can still get projects to pencil because cap rates have dropped. When we go back to 2015, it might seem like an eternity ago, but cap rates were at 5.5%. I mean, today even you would struggle to find deals trading at above 5. And
of new construction, core stuff for sure. I mean, like I said, the appetite that we've seen for capital on the investment side is offset any kind of interest rate increase, offset slowdown in income. The question is going to be, have we hit not the peak, the bottom of the cap rate, and that's going to, again, is that risk profile gets a little bit more conservative in terms of wanting more yield, going to put more constraints on construction again, and then again we're back to this whole issue of supply constraints are going to stop as we've got demand still coming.
Yeah, so I think that's what I see as the major risk here is traditionally rent growth has fueled expansions when cap rates are dropping. So you can have construction costs increasing, you can have rents not even going up that much, but when cap rates are dropping. But when cap rates are flat or going up, that completely changes the math. So I think that is, to me, looking out 3 years from now, rents will be going up again. Would be absent a major crash in the economy, but. All else, what we're likely to see is a smoother kind of landing in the next recession is what we're thinking. Of course, economists are wrong more often than we're right. But if that happens, you would expect to see rents going up. But if cap rates are the same or higher, I see that as being a major challenge in the traditional way that we've delivered apartments. Right. So it would require a different financial model, more patient capital, different kind of socially minded investors, public-private partnersship, different ways to kind of bridge that.
To try to get that supply side to keep up with demand.
Yep.
Yeah, interesting. Well, thank you so much for sharing this. You can find this Up for Growth report on our website and at the website here listed below. I'd like to thank Mike for coming back again. It's always great, always enlightening, and I'm sure we'll be talking to you soon.
Great, yeah, my pleasure.
Right,
always enjoy the conversations.
Yeah, great, thank you. That was very good.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.